Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 4th, 2025. How you doing? I appreciate you stopping by this weekend and watching my weekend review podcast. I hope you had a good New Year's Eve, and I wish all the best to you and your family for a very happy, healthy, and prosperous 2025. Just wanted to share a picture with you. I'm still here in Santa Marta, Colombia. My girlfriend took this picture of me playing baseball after the market closes. My girlfriend and our dog, we go to the beach and play baseball, and she took this picture. I didn't really even know she took it, and she showed me after. I was like, wow, that really is a beautiful picture. So just wanted to share it with you. So as far as the format today, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, all the positions that I have from last week, both the open positions and the closed positions. We are going to talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, where I placed my emergency stop, where I placed my end of day stop, how I managed the trade going forward, taking partial profits. If the trade gets up into significant overhead resistance levels, how I exit the trade in general. So hopefully this is going to be helpful for you to take a look at how I'm trying to be patient, waiting for my signals, and then how I manage the trades going forward. You know, the key in trading really is to be patient, wait for a confluence or a combination of signals to occur, position size correctly, and I'm going to show you how to do that or how I do that. And then how to manage the trade going forward. And the real key is that we want to keep losses small. You know, it sounds obvious, but we want to try to keep losses small. In trading, it's fine to have big wins, obviously. It's fine to have small wins. That's also fine. It's fine to have break-even trades. And it's fine to have small losses. But where you get yourself in trouble is when you have a large loss and it just gets bigger and bigger and bigger. So I always say this: try to be very patient with your winners and be very impatient with your losers. If you have a loser, just if it loses your level, just get on out. You can always get back in. And I have several of those potential or type of trades that I'm going to show you today where I did have small losses and they close under where I needed them to hold, but I can always get back in if it simply goes up. And I also want to say it's very important that you get yourself a process. You have a process that you follow. There's no magic to trading processes and trading strategies. There are many different of them. You can use the ones that I use. You can use other ones that other people use and teach. It's fine. But the key is following the process. There's no magic. There's no magic formula. Well, if there was a magic formula, it's just having just some type of decent trading approach and following it. But most people don't follow, and that's the problem. So if you want to make a resolution for the next year in your trading, get yourself a trading process, get yourself a strategy, and by all means, just follow. So we're going to take a look at the trades. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability, like I just mentioned, to create a process and then follow it. And that all comes down to you and your emotions. And so it's always helpful for me to teach it, and hopefully it's going to be helpful for you to hear. After that, every Friday night, I do go down through my master watch list, both on the daily time frames and the weekly time frames, and I look for potential trades for the upcoming week. Now, these markets are usually not where they need to be yet, because if they were exactly where they needed to be, I probably would have already taken the trade. But I like to do this every Friday night, go through each stock manually, one by one, take a look and go, geez, look at that. There is XYZ. Really not at a decent level right now, but if it went down, let's say 2 or 3% from here, oh, now you have the 200-day moving average. Now you have a 30 RSI. Maybe you have a double bottom bullish divergence or other things. And so I mark those and say, okay, if it gets there next week, that's the real sweet spot. Doesn't mean it's going to be a profitable trade, but from a professional trading standpoint, technical standpoint, that area would make sense for a potential bounce. And so that's what I'm going to show you. I have gone down through, I've whittled down out of my entire trading list, I think 9 on the dailies and I think 7 on the weeklies. But we'll go over and I'll explain what I'm looking for next week if and only if these particular markets get to the important level that I'm looking. And if they do, I will definitely consider the trade. So hopefully that will help you as well, give you an idea of the confluences and combinations of signals and levels that I am looking for. So, and if it is helpful today, if you do find any value in anything I mentioned today, if you could hit the thumbs up button, I would really appreciate it. It does really help out the channel, helps with the algorithm with YouTube, lets them know that there's some valuable content. And if you haven't subscribed yet, I'd appreciate it if you would subscribe as well. So, all right, well, let's get the U.S. legal disclaimer out of the way, and we'll come back and we'll get started. So hang tight for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me. So, interesting week. The market has been selling off. We did have a rally on Friday. The market sell-off did not surprise me at all. If you've been watching my channel for the last few weeks, you'll see that I did think we were quite near a top and due for a pullback, and we did have one. And so now, there's some good news and there's some bad news as far as the signals going forward. And I'll get into those more as we get further along in the podcast. But so I do use and I do teach 7 different strategies. And so as I go through each position here, I'll show you the strategy that I'm using. So this is Intel, INTC. So you see the green box here. This is what's called a bullish order block. And I took the trade here on the 10th of December at 2022, but the reason I took it goes all the way back to the 7th of August. And what keyed me off to this was on the 7th of August, we had this big down bar. This is called a bullish order block because it was the lowest closed bar before we had a change in structure. And the change in structure came when we took out this swing high. So when you go from a bearish structure to a bullish structure, the key then is you want to buy dips. And so going back in September, I did buy Intel back here, but the reason is, again, was on the 7th of August, largest down bar before market structure change. And when you have that market structure change, if you then come back into the order block, again, the order block is the high and low of August 7th that I've highlighted here in green. When you break structure to the upside and then come back into the order block, this is the area that I'm looking to buy. And I did buy, I entered here when we had this V2 in the bullish order block and had that nice trade there. I think I got out here. But now, these order blocks, when you go out in time, they tend to have a memory. So because we're in a bullish market structure, then we come back down to the bullish order block. This is why I entered. This was the signal that I entered on December 12th. And the confluence of signals were, one, we came into the green box. We came into the bullish order block. In addition to that, we also went under 30 over 30. That's a deep dip buy signal, and that's another strategy that I use. So almost always when I get into a position, it's going to be a confluence or a combination of one strategy or another. Rarely do I just take one trade based on one signal. So that's the reason for the trade. We came back into the bullish order block, number one, and really the entry signal was that during the day we went under the 30 RSI yet closed above the 30 RSI. So that's the reason for the trade at 2022. Now, is whenever I enter a trade, the most important thing, you've heard me say this many times, but really the most important thing is your position size. Because if you buy one share and it goes against you, okay, no fun, but you're not going to get hurt. But if you buy too large of a position and and the trade goes against you, you really can be in trouble. So keep this in mind in the new year. Position size correctly. And the way that I do this is based upon two things. It's based upon one, the size of the account, and two, what the value of the two ATR is. It says average true range 2. That just means 2 times the average true range. You take the average range of a day, you double it. This is the number that I use. So this is how I position size. First, how much is in your trading account? Let's just use $50,000 for an example. This works for any amount, but today let's just use $50,000. I take 1% of the account value. 1% of $50,000 is $500. Then I take that $500, I look for the value of the 2 ATR on the day that I take the trade. Right now it's at 141. So 500 divided by 1.41, that tells me to buy exactly 354.6 shares. I'll just round that up to 355. So for the way I trade, this takes into account your account value and the volatility of the market. If the volatility of the market is very high, this number is going to be higher, and therefore your number of shares are going to be lower. If the volatility is very low, this is going to be lower, and so you'll be able to buy more shares. Okay, so now we know the reason for the trade. We came back into the order block. We had an under 30, over 30 entry signal, got long 2022. I showed you how I position size by 355 shares. As soon as I enter, remember the 2 ATR that we just used? I take the entry price minus the value of the 2 ATR and I put it below my entry price. This is the thick red line here. This is my emergency stop. So if I have 355 shares and it goes down 141, how much have I lost? I've lost the $500 because we just did the math. Now, the good news is that this only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it's going to be because of my end of bar stop. And my end of bar stop is here at 1890, and that is just simply the low of the order block back in August. So I always go into a trade with two stops, an emergency stop and an end of bar stop. Like I said, the emergency stop only happens about 5% of the time. 95% of the time, the end of bar stop, which is always going to be closer than the emergency stop, will come into play. So we have the order block, we have the under 30, over 30. I enter 355 shares at 2022. I place my emergency stop 2 ATRs below. I place my end of bar stop at 1890, which is just the close of the order, the low of the order block. Then, as soon as I've entered the trade, I have those stops in place. Then I take my entry price and I add to it the value of 1.5. Right now, the value of 1.5 ATRs is $1.05. So I take my entry price, add on top of it the trailing stop level. And all that means is when I enter, if it gets to my trailing stop level, now I go into trailing stop mode. It doesn't mean I do anything. It just means I'm in trailing stop mode. And what trailing stop mode means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Okay, so everything I've talked about so far as the position sizing correctly, placing the emergency stop, placing your end of bar stop, placing your trailing stop level if it moves up your trailing stop level, these are all defensive moves. In other words, if the price goes against me and does something that I don't want, I need to take action. This is a defensive move. Well, and defensive moves are good, but I also like to play offense in my trading, and I play offense this way by taking partial profits into strength. And the way that I do this, I'll show you this exactly for Monday. Whatever position I'm in, I look at the closing price. Right now it's 20.56. So 20.56. Now I look for the value of the 0.45 ATR. Right now the value of the 0.45 ATR is 32 cents. So what I do is I always place 3 limit orders, 3 profit targets for the next day for 10% of the shares that I have remaining. So if I have 100 shares right now, for the next day, I take 20.56 was the closing price. I add to it the 0.45 ATR, which is 32 cents, plus 0.32. So for Monday, my first profit target is going to be $20.88. First profit target. I take my first profit target, 20.88. I add the 0.45 to it again, which is 32 cents. And my second profit target for Monday is going to be 21.20. And I'm going to do it one more time. I'm going to take the second profit target, 21.20, add the value of the 0.45 to it, plus 0.32, 21.52. That's going to be my third profit target for the day on Monday. And so, again, if I had 100 shares right now, I would place a limit order for 10 shares at the first profit target. I place another 10 shares at the second profit target, and I place another 10 shares at the third profit target. So regardless, 10% of however many shares I have going into the day at those 3 levels. If it goes down the next day, I'm not going to hit any profit targets, and then I have to recalculate for the next day. You know, a lot of times if it moves up, you'll hit 1, you take a little off. Maybe if you have a really good day, you hit 2. If you have a great day, you're going to hit 3. But what that does is it allows me to take partial profits off. I can lock those in. The market can't take it away from me. Reduces my overall position size so that if I do have a reversal, I don't have the full amount of shares, and it helps mitigate that loss. Make sense? So, with all that said, let's kind of review the trade. Into the order block, under 30, over 30, entry $20.22. Place the emergency stop, 18.37. End of bar stop, 18.30. Next day, doesn't do anything. Next day, moves up. I hit 1 profit target. I take a little of the profit off. Next day, nothing. Next day, up move again. 1 more profit target. Then we move down, 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 down. I thought, well, I'm probably going to get stopped out. But what I want to kind of point out to you here is, look, my stop, 1890, when the market opened on the 20th, look what happened. It opened to the penny at the bottom of that order block. So the order blocks mean something. The market respected them. And on that particular day, it gapped down a little, reversed back up, took some of the shares off. Next day moved up again, took some more shares off. Then we just kind of moved sideways here. And I did hit 1 profit target on Friday. You can see the 0.45 is 32 cents. We went up 34 cents. So I did take another profit target off there. So I still have not got to trailing stop level. If I do get to trailing stop level, then in the future, if I have a close below a previous bar's low, I will just take off half of the position. So, you know, this position not up very much, but take it into context, it's up 1.65%. But I think the important takeaway on this particular trade is that how the market respected that order block almost perfectly. And I was underwater quite a bit on this trade, so I'm glad to have recouped that and now finally into the positive on the trade. So Intel up 1.65%. All right, so that's Intel. Now let's go to AGQ. Okay, so AGQ is a different approach that I use, which is called an abandoned baby or an island reversal. In this case, it is called an abandoned baby. And I've highlighted the abandoned baby here in green. So crazy name, abandoned baby, what does it mean? Well, notice the day before. Do you see how we gapped down? So overnight, the market responded to whatever news or whatever the sentiment was, and it gapped down. However, the next day, it gapped up. So if you have a gap down followed immediately by a gap up, this is what's called an abandoned baby. And what you'll see more than not is if you have a gap down and a gap up, if you look out into the future, more times than not, the price will be higher. If you have a gap up followed by a gap down, this is called an island reversal. The only difference between an island reversal is an abandoned baby is just one bar, and an island reversal is one or more bars. This is three. See how it gapped up, followed by a gap down? This is bearish, and it certainly was bearish. However, this was a bullish abandoned baby, one bar, where it gaps down, followed by a little gap up, but still a gap up. And so this is what's called a bullish abandoned baby. And in the future, this more than likely will be bullish. Well, it did take off right away. I did not buy it here. I generally, on a bullish abandoned baby, it usually goes up and then kind of comes back, checks back before it has its move up. So I did buy here on the 31st at $33.62. So again, we have the bullish abandoned baby. We came all the way back into the abandoned baby. I was looking for some kind of rejection, either rejection of the top or the bottom, or some type of reversal inside of the bullish abandoned baby. And that's what happened here on the 31st. You can see we came inside this bullish abandoned baby. So I did get long at 33.62. Now, on bullish abandoned baby, or on abandoned babies or island reversals, I simplify the exits on this particular type of strategy, and I make it very simple. I take my entry price, I position size based upon the 2 ATR stop, and I place a 2 ATR stop, and I place that here at 30.87. But then my profit target, I double that. From a 2 ATR stop, I double it to a 4 ATR profit target. So I just enter this trade. I set my stop here at 38.7, my profit target here at 39.65, and I just let it go. One of the two is going to happen. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. That's asymmetrical risk to reward. Your potential reward should be more than what you're willing to lose. So if I'm willing to lose 2, I want to make 4. But the good news about abandoned babies and island reversals is about 70% of the time, in my experience, your profit target will be hit. So think about it another way. 70% of the time, you'll make 4x. 30% of the time, you'll lose 2x. That's a pretty good proposition, right? Even if it was a 50-50 and you lose 2 or make 4, that's still really good. But this case, in my experience, is better, where it's about 70%. So this particular trade at the moment, up 5.12%. And if we go back in time, look at this bearish abandoned baby. See how we gap up and then we gap down? Well, I didn't short it here, but I did short here when we got back into the bearish abandoned baby. And that was a massive, massive trade. So you can see that marked the top. This marked This abandoned baby marked the top. This abandoned island reversal marked the top. This bullish abandoned baby so far has marked the bottom. So this particular trade up 5.12%. And then Philip Morris. A lot of order block these days. So I did enter Philip Morris on the 30th at $120.10. I talked about this in the podcast last week that I was looking for. Again, we have this green box here. Why? Well, back here on the 21st of October was the lowest down bar move before we change market structure to the upside. When that happens, I want to wait for a pullback again into the green area and some kind of rejection. And so I did get long Philip Morris PM at 120.10. Now, I position size correctly. I placed my 2 ATR stop below. As always, my end of bar stop is simply going to be a close below the order block here at 117.22. And then I place my 1.5 ATR trailing stop level, 1.5 ATRs above my entry. Next day, after I entered, it did go up a little, not enough for a profit target. The next day after that, on the 20th, it did go up enough for me to hit one profit target, so I did take a little off, lock that in, and then on Friday, I did hit one profit target as well, because look, the 0.45 is 85 cents. It went up 92 cents, so it did move at least 85 cents from the close of the day, and so I did hit another profit target. So this particular trade is up 1.63%. Not too bad. Started off really good. So those are the three open positions that I have. Intel, the bullish order block up 1.65%. AGQ, the bullish abandoned baby trade up 5.12%. And Philip Morris, again, another bullish order block up 1.63%. So those are the three open trades. Let's take a look at the closed trades that I have. So this is Coca-Cola, KO. This is a very simple strategy here on Coca-Cola. I did enter at 62.36 with a deep dip buy. Deep dip buys use the 200-day moving average, they use the 300-day moving average and the 250-day moving average, and also an under 30 over 30. So I did buy here on the 23rd at 62.36 when we had an intraday rejection of the 300-day moving average. So I entered 62.36. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. And then, of course, I have my 1.5 ATR trailing stop level above. This trade just didn't work. It just didn't work. It came down here on the 30th, rejected the 300 during the day, closed above. That kept me in the trade. Next day, tested it again, kept me in the trade. Next day, gapped up, was looking good for a moment, came down, closed above the 300-day moving average by 1 penny, kept me in the trade. But Friday finally closed below the 300-day moving average, and that was the rules for my stop. So I had to get out for a loss of 1.02%. Never fun to take a loss, but look, the first loss is the easiest loss, and this 300-day moving average was just my line. If it closes above, I'm going to stay long. If it closes below, I'm just going to get out. If it keeps heading back down, I'll be very glad that I got out there. On the other hand, the 300-day moving average was important enough for me to take the trade. On Monday, if it closes back above the 300-day moving average, well, I can just get back in again. If it goes screaming on up, great. But that's the line in the sand. For deep dip buys, the line in the sand are the 200-day moving average, 250, 300, and the 30 RSI. These are key levels that large financial institutions key off of. They don't work all the time. Clearly, this one didn't work. But it's just a good dividing line. It's your line in the sand. I'm bullish above, I'm out below. And that's really it. You know, if we go lower to the 30 RSI, that will be another level for me to look at. So if it goes to the 30 RSI and rejects it, I can get long there. Alternatively, if it closes above the 300-day moving average, I can get long there. But nonetheless, losing trade, but you're going to have a lot of losing trades. The key is to keep them small. This was a small loss at 1.02%. Microsoft, another small loss, and again, a deep dip buy. So on the 30th of December, we came down, we intraday rejected the 200-day moving average, and really all that means is during the day we went below it, but we recovered, closed above it. I got long 424.83, position size correctly, placed my emergency stop 2 ATRs below, my end of bar stop just to close below the 200-day moving average. Well, look what happened. Got long at 424.83. Next day, closed below the 200-day moving average. What do? I simply get out for a very small loss, right? Even if it got to my emergency stop, I'm losing 1% of my capital. Here, it just barely closed below. Very small loss for a loss of about 0.95%. So not too bad. And again, if Monday it closes above the 200-day moving average, well, I can take an entry there as well. So this one a loss as well. And what you'll notice with my trades at least is if I have a winning trade, I will be in it I will be in it much longer than I will be if I have a losing trade. I mean, look how quickly I was out of these trades because why? They just didn't work, right? Coca-Cola, well, I guess I was in this one a little bit, but small loss. But Microsoft, look, in one day, out the next day. That's how quick I got out when I'm wrong. But if I'm right, I'm going to stay in them much longer and have the process to keep me in. So Microsoft down 0.95%. Last but not least, Verizon. Okay, I did take Verizon here on the 26th of December. I like this confluence of signals because this is a deep dip buy. The previous day, on the 24th, we closed below the 30 RSI. The next day, we closed above the 30 RSI. That's my signal. Under 30, over 30. That's my signal. In addition to that, the confluence of signals was the under 30, over 30, and a V2. V2 consists of 3 bars. Bar 1, bar 2, bar 3. In this case, bar 2 went under bar 1's low. Bar 3 closed above bar 1's close. V1s, V2s are great entry signals for any trading strategy. And if you want to learn more about those, just go to my YouTube channel. I have a video there about V1s, V2s. But that's the combination of signals. Under 30, over 30, plus the V2. I got long at 39.96. Placed my emergency stop 2 ATRs below. Placed my 1.5 ATR trailing stop level 1.5 above. My end of bar stop is simply a close below the 30 RSI. And then here on the 30th of December, we did close below the 30 RSI. No fun when it stops below your entry because you got to get out, and I did get out for a loss of 0.78%, but at least it's a small loss. And then, as many times, what happens? You get out and immediately goes back up. You're like, dang, but it's okay. Because had this just kept going lower and lower and lower, do you think I would have been happy to get out of my under 30, over 30? Of course. But the key here is to stick to your rules, preserve your capital, respect your rules, and I had to respect my rules that it closed under the 30 RSI, and that's fine. So the three closed out positions were all losers this week, but small ones. Coke for a loss of 1.02. Microsoft for a loss of 0.95, and Verizon for a loss of 0.78. And that's fine. Small losses are just part of your trading. So, okay, let us talk a little bit about trader psychology before we start looking at potential trades for next week. Okay, as a trader, you should have no opinion. The more opinion you have, the harder it gets to get out of a losing position, by Paul Rodder. Folks, this is so true. I have friends, trader friends, that have very strong opinions on things. And, you really should hold your opinions lightly in trading. I mean, really, it's impossible not to have any opinions. But ideally, you should have no opinion, because if you have an opinion on a trade, like, oh, this one's got to go up, this one should go up. Well, if it doesn't go up, then you have a conflict in your mind, like, well, it should go up, but it's not going up. But, maybe it's just going down for a minute and will go up later. So I'll just stay in the trade. Famous last words, everyone. The more opinion you have, the harder it is to get out of a losing position. And it's very important to get out of losing positions quickly. Remember, be very impatient with your losers. Be very patient with your winners. But if you, for some reason in your mind, say, no, this has got to go up, this should go up, then you're less likely to adhere to your rules. So that's why what Paul Rodder's saying, the more opinion you have, the harder it is to get out of a losing position. And your demise in trading will come from staying in a bad losing position too long. But if you have no opinion about anything and you say, okay, hey, this was a deep dip buy. This went under the 200, over the 200, had a V1, maybe some other things, but I don't know anything about this stock. That's really the best mindset to be in, because the next day, if it closes underneath, you go, well, I don't know, I guess it'll just close underneath. I'll just get out. That's proper trading. But if you're like, no, this is supposed to go to the moon, and so I'm just going to hold it, what are you going to do if the 200-day moving average is like $100 and you like it at $100, and then the next day it closes at 95? You say, oh, I'll give it a couple days, see what happens. And now it's 90. Well, if you loved it at 100, you've got to love it at 90. How are you going to get out? And then if it keeps going down and it's 80, how do you rationalize yourself, if you loved it at 100, to get out at 80? It's just a vicious cycle, everyone. The first loss is the easiest loss. And, for 2025, if you struggled with this, just try it. Say, the market's telling me it doesn't want to be above the 200, or the market's telling me it doesn't want to be above this price or this price. Well, the market probably knows better than you do. So adhere to your rules, and try not to have those opinions, because again, the more opinion you have, the harder it is to follow your rules. And to make money in long term, you have to follow your rule. So why not do everything you can to make following your rules easier? In any trading strategy, the weakest link is not the rules. It is you. It is the trader. And what Paul's saying here is, as a trader, you should have no opinion. The more opinion you have, the harder it is to get out of losing position. It really is. And I understand it's hard not to have, but that's what separates real, winning traders and successful traders from losing traders, is they follow their rules. And one of the ways to follow your rules better is not to have an opinion. So anyway, hope that was helpful, everyone. And let's head over and take a look at some potential trades for next week. Okay, so for next week, I have the potential of 9 signals, or 9 potential markets on the daily time frames. And I always mention this before we get into this. There's a potential that all 9 of these are going to trigger on Monday. Does that mean I'm going to go ahead and take all 9 positions? No. I always only take 1 position per day. Even if I have 10 signals, I've got to narrow those 10 signals down to the best signal. And how do I do that? Well, I count things up. I give the trade a quality score. I say, okay, stock 1 has 1 signal. Stock 2 has 2 signals. Obviously, I'm going to take the one that has 2 signals. So I look at the confluence of signals, how many it has. I look at the risk to reward ratios. I look at how these particular markets look on higher time frames. So like if I'm trading the daily, I'm going to look at the weekly to look for some kind of supporting technical signals there. And then I also look at the relative strength of that market on that particular day compared to the rest of the market. If one particular stock is stronger and the entire market is down, but this one's up, that's going to give it more bonus points as well. And so This is what I teach my students. I do teach a one-on-one course. It's a 15-hour course, 3 hours per session, 5 sessions. I teach you all 7 of the different trading approaches that I use. I teach you step by step. We do all sorts of simulation trades where I say, okay, pick a random stock, pick a random time frame. Let's go in. And after I teach you the strategies I have on these random charts, I have you actually trade. So I can see you taking the trade. Tell me what you're going to do the entire trade bar, and we go bar by bar by bar. In my opinion, it's one of the best ways to learn how to teach, because a lot of people teach trading, but then they don't run their students through different scenarios so they can see where their students at, whether they know what the actual rules are. And I love to teach. I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level and everywhere in between. All you have to do is write me. My email's in the link of the description. If you do write me, we'll set up a free Skype call, and just like to get to know the potential student better, ask them about their trading goals, their challenges. It's a good time for them to ask me about the format or anything about the course. And then after the call, it's not a sales call. After the call is finished, that's it. And then if you want to take the course, you just write me back and we can start. But it's a great investment in you. It's a great investment in 2025. And so many of my students have told me, Greg, I'm so glad I took this course. I'm so much of a better trader than I used to be. So I'd love to teach you. Just send me an email and we can get things started. But again, 9 different potentials here for next week. If they all trigger on the same day, I'm going to narrow it down to the best one. So let's start with Apple, AAPL, obviously. So Apple had this tremendous run up, and now we've had this pullback. And so what I'm looking at on Apple at the moment is this level here at 237.20. Right now we are at 243.36. So not quite there. But the reason I'm looking at this is, let's go back here to this potential high back in October. So this was a high, then we came back down, then we broke out through this high. Why is that important? Well, when you have, this was resistance for a long time, and then we broke out through this resistance. So when you break out through resistance, that old resistance now becomes support. So if we come back down, this high should act as some type of potential support. But look, so I drew the line here at this high, draw it out into time, and what do we have here? We have the 50-day moving average. See how they bisect? They come together here. That's a significant area of support for Apple right here, because it's the support of the previous resistance that we broke through now should become support. In addition, it dovetails right with that 50-day moving average. So I don't use the 50-day moving average a lot. Again, like on the deep dip buys, I use the 200, the 250, the 300s. But in this particular case, I am going to potentially use that 50-day moving average as my level if we reject it. So that's what I'm looking for next week, is if we come down, we bounce at the 50-day moving average, or we intraday reject it, which means you go down below it and then close back above it, or we close below it and then close above it. That is the key level that I'm looking for Apple. And I haven't traded Apple for a while, but when I was going through the charts last night, I was like, oh, that's a really good level, because it's the support of the previous resistance and the 50-day moving average right there. So that's what I'm looking for on Apple, is some kind of rejection next week of the 50-day moving average. If it rejects it, I'll potentially take the trade. Of course, I'll position size, place my emergency stop 2 ATRs below, and my line in the sand will be the 50-day moving average. As long as it stays above, I'll stay in. If it moves up, I'll take partial profit, so forth and so on. But if it closes even 1 penny below, I'll simply get out. So glad to have an opportunity to potentially trade Apple, and I really love it here at about the 237.20 level, but I'm not going to do anything with it at this point unless it goes down, tests that 50, and rejects it. All right, Adobe. Wow. Ah, boy, that's something, that trade. Well, I did have a really nice weekly trade on Adobe, and I got out at the top. Why? Because it was earnings, and I never hold through earnings. And luckily, I didn't hold through earnings. Look at this. But now we're kind of getting ridiculously oversold here. But what I'm looking for here, this is what jumped out at me here, was this gap down bar. Remember the bullish abandoned babies or the bullish island reversals? What I'm looking for next week is maybe on Monday, if we gapped up, then this would cause this to be in a bullish baby. Or maybe we go sideways for a couple more days and then have a gap up. That would be a bullish island reversal. So there is nothing here whatsoever. The reason I'm pointing it out here right now is we did have this big gap down. And if you have a gap down, followed the very next day by a gap up, this would make this a bullish abandoned baby, and they very often mark the low. Or conversely, if we have a couple more days sideways and then a gap up, it would be an island reversal. So that's what I'm looking for on Adobe. Really, next week, what I'm looking for is a bullish abandoned baby that forms, or a bullish island reversal that forms on Adobe. And if it doesn't, I'm just not going to get in the trade, because then there's no signal. But a lot of times when you have these big gap downs, very often you'll have a gap up, and that will signify a short-term low and a nice trading opportunity. ARK, ARKK. Okay, I mentioned this in the last podcast. Here, this is a bearish order block. I've talked a lot about the green bullish order block. Well, this is a bearish order block. What makes it a bearish order block? Well, we have the highest up bar close that happened here on the 16th before change in market structure. Market structure change came on the 18th on this big down bar. When we took out these swing lows, this changed market structure from upside to downside, to the downside. 1218, this was a significant down bar that changed lots of things, psychologically, sentiment, everything, and technically by taking out the swing low. But again, when you're in a big, strong uptrend and you have a big break to the downside, very often you will rally initially because those initial buyers come in, and then it will fail. Last week I said if we get to the bottom of the order block and reject it, I will potentially short this. Well, it didn't quite get there, then it sold off, but it's still there. And remember, this bearish order block, this red box here, tends to have a memory. So what I'm looking for potentially next week on ARK is maybe another day or two of a rally up and rejection of this order block. The low is a 61.48. So next week, if we get to 60.41.8 or higher and then close back below, that's a rejection. So that's one potential. Two is if we get in the bearish order block, maybe open up and then reverse backwards, kind of like the opposite of Philip Morris, where we got in and we went down below and came back up. That would potentially also get me into the trade if we open higher and close lower. Alternatively, if we get to the high of the order block, 63.14, if we get up there and then reject it and close back in the bearish order block, that would also get me short. So again, the big picture takeaway here is on the 18th, we had a big market structure change, move to the downside. Now, the proper thing to do, at least the way that I look at it, is short the rallies. And you can see it was good to short the rally here, but I'm looking for another rally to short either rejection of the bottom of the order block at 61.48, alternatively some kind of bearish reversal inside the order block, or a rejection of the top of the order block at 63.14. Budweiser, BUD. Wow. Did everyone stop drinking beer? Look at this chart, everyone. Holy smokes. It's incredible. It's incredible, really. Similar to Adobe, I am looking for next week a potential bullish abandoned baby or bullish island reversal up. That's it. Monday, if we gap up and create a bullish abandoned baby, abandoned babies are very strong indicators of higher moves to the upside, or island reversals as well, where if we have maybe 1, 2, 3, even 4 days, and then a gap up, that would most likely signify a short-term low. In addition to that, so nothing's happened here whatsoever. There is no signal. Again, I need the bullish baby or bullish island reversal to get me in the trade. But big picture, look at the lows here. The lows, lows, lows. See how deep the red MACD bars are? And then we rallied a little bit. Are we lower here than here? Obviously. Here, the MACD bars are red, but they're not very deep. This is showing you're running out of selling momentum. And here even, we're lower here than here. But even though we're lower here, there are no red bars whatsoever. This is called a bullish MACD divergence. This looks very bearish, but from a MACD perspective, this is bullish because the math on the MACD indicator is showing even though we're going lower and lower and lower, it's coming on less and less strong MACD downward momentum. And that's just basically what that's indicating, is that you're running out of sellers. And if you run out of sellers, the implication is you are going to go up. Well, that's always what happens. If you run out of sellers, then things go up. If you run out of buyers, things go down. So big picture, when we look at the lay of the land, we have bullish MACD divergence happening here. We just need an entry signal. And for me, the entry signal next week would be on Monday, for example, if we gap higher, that would cause a bullish abandoned baby, or 2 or 3 or 4, or however many sideways days, and then a gap up, making that island bullish. That would also be an entry. So a bullish abandoned baby on Monday, or a bullish island reversal sometime in the future. But I really quite like this, especially with the MACD. DoorDash. Okay, back to the short side. Here we have the bearish, the bearish order block, highest up bar close before market structure change. So if you have market structure change to the downside, you want to look to short the rallies. I did not, even though we got here, I did not short this on Friday, even though we got to the bottom here, because we didn't reject it. So Monday, if we do reject it and go down, then I will consider getting short DoorDash. I'll place my 2 ATR stop above. My end of bar stop will be a close above the high of the order block. The high of the order block is 179.95. Ideally, I'd like to see it come up higher, because the higher it goes, the better my risk to reward ratio is. So, for example, Monday, if it rejects the bottom of the order block, I'll consider. If it goes higher, if it opens higher and reverses, that would be more ideal. Or the best would be if we come all the way up, test the high of the order block here at 179.75 and reject there, because that would give me the better risk to reward. So the higher and higher and higher I go in here, the better my risk to reward ratio. So I'm the least excited about it rejecting the bottom of the order block, because then my risk to reward is higher. But nonetheless, I am looking to potentially short Dash somewhere in this red order block between 179.75 and 175.04. INDA, India. Okay, well, this is a good example, everyone, of two things. One, of a bullish island reversal. This is kind of what I was talking about, what I was looking for on Budweiser. Look, we gap down, then we have 1 day sideways, and then on Thursday we gap up. See how this becomes an island, not a baby, because a baby's just one, but an island. Gap down, nothing, gap up. This more than likely signifies a short-term bottom. Now, I did not buy this here. I'm waiting for it to come back down, test the top of that bullish island reversal, and that's what would get me long if we came back down to 52.76, which is the high of the island reversal. And if I did get long there, then I place a 2 ATR stop below, 4 ATR profit target above. Another thing of note here is look at the orange line here, this is the 300-day moving average. I could have taken this trade on the 31st on this signal alone. We went below the 300, closed above it. Even the previous day, we tested twice, and they said, okay, that's enough. We don't have enough sellers, and it's going up. So this is a good example of a deep dip buy as well. And by the way, if you like, deep dip buys are such good starting strategies. And I have a really good course on udemy.com. The link's in the description of this video. But I have a very good, affordable course where I teach you step by step how to trade the deep dip buy strategy. It's 9.5 hours of video, so there's a lot of video there. There's a lot of content. I think it sells between $30 and $50 on udemy.com, and I've had such good reviews, 4.85 stars on that, and I've sold so many around the world. So that's a really good place to start. I mean, obviously I teach the one-on-one course, better, I think, one-on-one, but it's more expensive. But as a way to get started, this deep dip buy on Udemy is really, really good. And this is just a good example of two things going on here: a bullish island reversal and a deep dip buy that respected the 300-day. But for me, I didn't take the trade. I'm waiting for it to pull back. See, a lot of times you get these bullish abandoned babies and the island reversals, and they gap up, but I don't want to chase them at this level. And then they come back down before you have another move up. So that's what I'm waiting for on INDA, is a test of 52.76, just like I did on the AGQ trade. Microsoft. Okay, so I had this trade. I had to get out of it here on the 31st because the day before deep dip buy, we rejected the 200, got in, good risk reward ratio, and then the next day we closed below. I just got out. But we are still under the 200-day moving average. But next week, if we close above the 200-day moving average, then I could potentially get in again and use that 200-day moving average as my line in the sand. So I don't know. This may close above the 200 on Monday, but one of these other setups may be better, right? So just because it closed above the 200 doesn't mean I'm just going to rush in and buy Microsoft, because one of the other markets may look better and have more signals. But nonetheless, if it does close above the 200 on Monday, I may potentially re-enter Microsoft. QQQs. Okay, so let's take a look at the market a little bit in general. So these are the Qs. And so let's just kind of look at it big picture. If you remember on the podcast I had back here in the middle of December, I said I'm very concerned about the market being at a top here. Do you remember me talking about the three little Indians, where you have three symmetrical tops? Top one, top two, connect those tops together, go out into time. If you get up to that third top, that's three little Indian, very likely marks the top. Look at that. I would say it pretty much nailed the top, right? And then on the 18th, we had the big sell-off, which changed market structure from clearly to a bullish market structure to clearly bearish. And when you change from bullish to bearish, you want to short the rallies. Well, we came down, we rallied, we got into the bearish fair value gap, didn't quite get to the order block, and then had the move back down. So right now, positives and negatives. Look at the bottom here, connect that to the bottom here. This is your long-term trend line going into the future. Well, last week we closed below it. The good news is we closed back above this long-term trend line. Long-term trend lines mean a lot. I mean, look at the trend line here. You connect that top to that top. We rallied right to it before we had this huge sell-off. So the good news is we have the bullish trend line underneath us. The bad news is that when you connect the top here to the top here and move back down, this is going to be resistance. This is going to be support. On the big down day on the 18th, right in the middle of that big down bar, there's going to be some inherent 50% Fibonacci resistance. So this area in here at about 525, probably going to bring in some sellers. One, because of the big down bar move, and two, because of the opposing trend line that's above us at all. So I think we are going to stay in this tight little range here on the Qs. So am I going to short the Qs up here? Not sure. I really just pretty much put these in here because I wanted to show you the structures of the markets and to show you, yes, we have a little support below us, but we also have resistance above us. That's on the Qs. And then on the SPY, very similar. We have the highest up bar close before market structure change. We have the bearish order block here. You can see connecting the bottoms of the bottoms here to the bottoms here, running out in time. On Thursday, we had an intra-bar rejection of that long-term trend line, and it did hold, and then of course we had the rally on Friday. But again, we have support below us with this long-term trend line here. We have resistance above us with the overhead downward sloping trend line as well. And of course on the big day on the 18th, halfway, that is resistance as well. So what I'm saying on the SPYs and the Qs is we have a little support below us, but we also have significant resistance above us. And that day of the 18th was very substantial. I mean, I think the highs are in for quite a long time. I could be wrong. Maybe we go back up and test this order block. I'm not sure, but there was a lot of selling. There's a lot of weight above us, that the market is very heavy above us. And so just make sure that whatever you're looking to buy, that it's a good risk to reward ratio and that you have some upside potential on this move. And me personally, if I just had to buy the SPYs or Qs here, I probably wouldn't do it because there is a lot, I think there are a lot of sellers up in this area here. So, okay, those are the dailies. Let's get to the weeklies. Weekly bars close on Fridays. So I make my decision every Friday on the weeklies. And this is AMD. Been talking about AMD for a while. Again, these are weeklies. So this is a weekly 200-week moving average. This is a deep dip buy. I've been waiting for AMD to come back down and test this 200-day moving average. If it does test it, okay, then I can potentially get long AMD. If it next week it went below the 200, but by Friday it closed back above, and then yeah, I could get in. Doesn't mean it's going to be a winning trade, but it means I know exactly where my line in the sand is, and if it closes below that 200, I'm out. But I'm bullish as long as it's above the 200. I'm bearish and out if it's below the 200. So looking at AMD next week for some kind of bounce or potentially intrabar rejection. FXY is the Japanese yen. And you see this green box down here. That should go to show you that I'm pretty much looking to get long FXY if we get back to this green box. Why this green box? Bullish order block on the weekly. Lowest down bar close before market structure change. If you have a market structure change to the upside, I want to buy if we get back to the green box. And some kind of rejection of the order block on the 28th of June. So the high there is 58.06, the low is 57.49. So first thing that I would look for is a rejection of the high, which is 57.49. That could potentially get me long. If we go further down into the bullish order block and maybe open lower, close higher, that would also get me long. Or if we reject the bottom of the order block at 57.49, that would also potentially get me long. But the Japanese yen had this huge move up and now down, but it's getting close to a potential buyable area. GDX. This one's pretty simple. It's just a deep dip buy off of the 200-day moving average, the black line. The other thing is the negative third ATR channel right here. 92% of prices tend to stop going down or bounce up at the negative third ATR channel. That dovetails right there perfectly with the 200-day moving average. I've been talking about GDX and getting to the 200 for a while. Looked like we might get there, but last week we did rally up, but who knows? We could go back down. So that's what I'm looking for next week on GDX is a rejection of the 200-week moving average. Johnson & Johnson, looking for, this is a deep dip buy as well. 300-day moving average, 300-week moving average. You can see last time we got to the 300-week moving average, that was it. There were no more sellers under there, and we rallied up hard. Now we've come back down to it. Week before last, we did close back above. I didn't take the trade. This week, we closed back under. And next week, we may potentially close back above the 300. I would like that trade better than just a straight down rejection of the 300-week moving average, because now we have some sideways motion. There's some price discovery going on here. This is going sideways because there's an equal amount of buyers or sellers. And the longer you have an equal amount of buyers or sellers, you're going to have some kind of trend taking place. Sideways motion leads to trends. We just don't know if the trend's going to be up or it's going to be down. But the first indication that it may be up is that we close above the 300-day. So that's what I'm looking for on Johnson. Johnson's close above the 300-day moving average. Merck, same thing. Look at the 200-week moving average. Look how we, back on the 11th, on November 15th, we just literally touched the 200-week moving average. So when people say moving averages don't work, yeah, they don't work all the time, but they work more than not. And this is a perfect example of that's exactly where the buyers came in. Will they come in here again? I don't know. It's potential, but that's what I'm looking for, is a potential bounce at the 200. Next week, VIX. I didn't take this trade, even though I talked about it on the podcast. Another bullish order block back here on this July 12th. Down bar close before we change market structure to the upside. And then look, it got right down to the bullish order block. I didn't buy it. I'm not sure why I didn't buy it. I guess I was looking at something else. And then we had that huge move up. When I'm talking huge, that was huge. That went up 34%. So I didn't buy it this time, but I'm potentially getting ready to buy it again here if we come down. So basically the high of the order block there is 41.88. We're at 44.10. So I do want it to at least come down to 41.88 and to potentially, because buying VIX, buying volatility at that price is very low, and it makes sense technically, right? And last time, it's exactly where it got before it took off again. Will it get there again? I don't know, but we'll see. And then last but not least is XLV. That is healthcare. Healthcare has really gotten slammed, really, but that 200-day moving average, look what happened last time on XLV, back October 23rd. It literally touched the 200 and then went up for a year. Will that happen again this time? I don't know. But if you're looking to buy at a moving average, look in the past and say, did it respect it last time? Well, obviously, clearly, 100% it did. Will it this time? I don't know. But if it did last time, there's more of a chance it will this time as well. So that's what I'm looking for on XLV, is weekly rejection of the 200-day moving average. So that is basically it, everyone. I appreciate you coming, spending your time here. I hope it was helpful. Again, if it was helpful, really would appreciate if you hit the thumbs up button. If you're interested in one-on-one, my one-on-one course, please contact me. Love to teach you. It's 15 hours worth of me teaching you. It's not an easy course. I take you through. We run through all the rules and then lots of simulations. But I promise you, by the time you get done with that course, you are going to know a lot more about trading. You're going to have a lot of tools, a lot of strategies that you can use. So keep that in mind. Just send me an email. Also, if you're interested in the one-on-one course, not the one-on-one course, but the online course, the link to the Udemy course is in this as well. But I always like to leave off with, please try to go out and do something nice for somebody. Really would make the world a better place if we all did one nice thing for another human being. If you could go out and maybe try to do one nice thing for an animal today, that would be great. They appreciate acts of kindness like we do as well. So enjoy the rest of your weekend. God willing, I'll see you next week from Colombia, as I'm staying another month. But thanks so much. And if you have any comments or questions, please put them in the comment section, and I'll do my best to reply to it. So thanks a lot, everyone. Appreciate you being here. Have a great rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.